Investing is a powerful tool for building wealth. It's not just for the rich or financially savvy. Anyone can invest and grow their money over time. Investing allows your money to work for you. It helps you achieve financial goals like buying a house, funding education, or retiring comfortably. Many people think saving money is enough. While saving is important, investing can offer higher returns. Inflation can eat away at your savings. Investing helps you beat inflation and grow your wealth. It's a way to secure your financial future. Starting to invest can be intimidating. There are many options and terms to understand, but with the right guidance, anyone can learn to invest. This guide will walk you through the basics. By the end, you'll be ready to start your investment journey. There are several types of investments. Each has its own benefits and risks. Understanding these can help you make informed decisions. Let's look at 4 common types: stocks, bonds, mutual funds, and ETFs. Stocks represent ownership in a company. When you buy a stock, you own a piece of that company. Stocks can offer high returns, but they can also be risky. The value can go up and down based on the company's performance and market conditions. Bonds are loans you give to companies or governments. In return, they pay you interest. Bonds are generally safer than stocks, but offer lower returns. They can be a good way to balance risk in your portfolio. Mutual funds pool money from many investors to buy a variety of stocks and bonds. They are managed by professionals. This can make them a good choice for beginners. Mutual funds offer diversification, which can reduce risk. ETFs, or exchange-traded funds, are similar to mutual funds. They also pool money to buy a variety of assets. However, ETFs trade on stock exchanges like individual stocks. This makes them more flexible and often cheaper than mutual funds. Before you start investing, set clear goals. Knowing what you want to achieve can guide your investment choices. Start by asking yourself what you are investing for. Is it for retirement, a down payment on a house, or your child's education? Next, think about your time horizon. How long can you leave your money invested? Short-term goals might need safer, more liquid investments. Long-term goals can tolerate more risk as there's time to recover from market fluctuations. Consider your risk tolerance. How much risk are you comfortable with? Some people can handle the ups and downs of the stock market. Others prefer the stability of bonds. Your risk tolerance will influence your investment choices. Finally, set specific, measurable goals. Instead of saying, "I want to save for retirement," say, "I want to have $500,000 in my retirement account by age 65. Specific goals can help you track your progress and stay motivated. Investing always involves some risk, but you can manage and reduce risk through diversification. Diversification means spreading your money across different types of investments. This way, if one investment performs poorly, others might do well. One way to diversify is by investing in different asset classes. For example, you might invest in stocks, bonds, and real estate. Each asset class reacts differently to market conditions. This can balance your overall risk. Another way to diversify is within asset classes. Instead of buying just one stock, buy several from different industries. This reduces the impact if one company or industry struggles. Mutual funds and ETFs are great tools for diversification. Remember, diversification doesn't eliminate risk, but it can make your investment portfolio more stable. Regularly review and adjust your portfolio to maintain diversification. This helps you stay aligned with your goals and risk tolerance. Section 5. Starting with a small budget. You don't need a lot of money to start investing. Many investment platforms allow you to start with a small amount. Some even offer fractional shares, letting you buy a portion of a stock. This means you can invest in expensive stocks with just a few dollars. Start by setting aside a small amount each month. Even $50 can make a difference over time. The key is consistency. Regular, small investments can grow significantly through the power of compounding. Consider using robo-advisors. These are automated platforms that create and manage a diversified portfolio for you. They often have low minimums and fees, making them ideal for beginners. They use algorithms to balance your portfolio based on your goals and risk tolerance. Don't be discouraged by a small budget. Everyone starts somewhere. The important thing is to start now. As your income grows, you can increase your investment amounts. The earlier you start, the more time your money has to grow. Section 6. Common beginner mistakes. Beginners often make mistakes that can cost them money. One common mistake is not doing enough research. It's important to understand what you're investing in. Don't rely on tips from friends or the latest market trends. Another mistake is trying to time the market. Many new investors buy high and sell low, driven by emotions. It's better to invest regularly, regardless of market conditions. This strategy, known as dollar-cost averaging, can reduce the impact of market volatility. Overconfidence is also a risk. Some beginners think they can beat the market with little experience. This can lead to risky investments and losses. It's important to stay humble and keep learning. Finally, avoid putting all your money in one investment. This lack of diversification can be dangerous. Spread your investments across different assets and industries to reduce risk. Remember, investing is a long-term game. Patience and discipline are key. Section 7. Practical tips for new investors. Start by educating yourself. Read books, follow financial news, and take online courses. The more you know, the better decisions you'll make. Knowledge is your best tool in investing. Create a budget and stick to it. Decide how much you can afford to invest each month. Don't invest money you might need soon. Investing should be for long-term goals. Use technology to your advantage. Many apps and platforms make investing easy and accessible. They offer tools for tracking your investments and learning about the market. Some even provide personalized advice based on your goals. Finally, stay patient and disciplined. Investing is not a get-rich-quick scheme. It takes time for investments to grow. Stick to your plan, keep learning, and don't let short-term market fluctuations shake your confidence. Section 8. The role of research and education. Research is crucial in investing. Before you buy any investment, understand what it is and how it works. Look at the company's financial health, industry trends, and market conditions. This helps you make informed decisions. Education goes hand in hand with research. Take advantage of free resources like online courses, webinars, and podcasts. Join investment clubs or online communities. These can provide valuable insights and support. Stay updated with financial news. Markets can be influenced by economic events, political changes, and global trends. Knowing what's happening can help you anticipate market movements and adjust your strategy. Remember, investing is a continuous learning process. The more you learn, the better you'll become at managing your investments. Make research and education a regular part of your investment routine. Section 9. The power of patience in investing. Patience is a key virtue in investing. Markets go up and down, but over time, they tend to grow. It's important to stay focused on your long-term goals. Don't let short-term market fluctuations derail your plans. One way to practice patience is by sticking to your investment strategy. Regularly review your portfolio, but avoid making impulsive changes. Trust in the process and give your investments time to grow. Reinvest your earnings. If you receive dividends or interest, reinvest them instead of cashing out. This can accelerate the growth of your investments through compounding. Finally, remember that successful investing is a marathon, not a sprint. Building wealth takes time and discipline. Stay patient, keep learning, and stay committed to your goals. Over time, you'll see the rewards of your patience and perseverance. Section 10. Conclusion. Start your investment journey today. Investing is a journey that anyone can start. It's a powerful way to build wealth and secure your financial future. By understanding the basics and following a step-by-step approach, you can become a successful investor. Start by educating yourself and setting clear goals. Diversify your investments to manage risk. Don't be afraid to start with a small budget. Avoid common mistakes and stay patient. Remember, the earlier you start, the more time your money has to grow. Investing is not just for the wealthy or experienced. With the right knowledge and tools, anyone can grow their money. Take the first step today. Your future self will thank you.